It's a regular Wednesday morning in 2026. Nvidia releases their quarterly earnings. The numbers are fine. Revenue up, still dominant in AI chips, but then comes the guidance. We're seeing signs of customer digestion. Some enterprises are pausing deployments to evaluate ROI. Customer digestion, pausing deployments, evaluating ROI. Wall Street translates, customers are realizing they're not making money from AI. Nvidia's stock drops 18% in a day. Microsoft drops 12%, Google down 10%. The entire Magnificent Seven tech stocks lose $1.2 trillion in market value in 48 hours. But this isn't just a tech stock correction. This is the moment the market realizes that the AI boom, the thing that's driven markets for 3 years, the thing that added trillions in market cap, the thing everyone said was different this time, might be the biggest bubble since the dot-com crash. And unlike 2000, this bubble isn't just about overvalued tech stocks. This bubble has sucked in massive amounts of capital, transformed entire industries, and created expectations that reality simply cannot meet. Let me walk you through how we got here, what the breaking point looks like, and why 2026 might be remembered as the year everything changed. Let's rewind to understand how we got here. Late 2022, ChatGPT launches. Within weeks, it has tens of millions of users. Within months, over 100 million. It's the fastest growing consumer application in history. The narrative takes off. AI is going to transform everything. Every company, every industry, every job. And unlike previous tech hypes, this one has a tangible product. You can use ChatGPT. You can see image generation. You can watch AI code. It's not vaporware. It's real. So the money floods in. Venture capital, corporate investment, stock market valuations. Between 2023 and early 2026, over $500 billion has been invested in AI companies and infrastructure. Nvidia becomes the poster child. Their GPUs are essential for training AI models. Stock goes from $150 in late 2022 to over $900 by early 2025. Market cap explodes to over $2.3 trillion, making it briefly the most valuable company on Earth. Microsoft invests $13 billion in OpenAI. Google scrambles to catch up with Gemini. Meta pivots hard to AI. Amazon dumps billions into AI services. Every tech giant is in an arms race. And it's not just tech companies. Every corporation on Earth becomes an AI company. Banks are AI companies. Retail is AI. Manufacturing is AI. Healthcare is AI. Everyone's either implementing AI or claiming they will. The stock market rewards this. Companies that mention AI in earnings calls see their stocks jump. AI-related companies trade at absurd valuations, 50x, 80x, even 100x revenue in some cases. Here's where it gets really crazy, the capital expenditure. In 2023, Microsoft spent $50 billion on data centers and AI infrastructure. In 2024, $55 billion. In 2025, $65 billion. Google is spending similar amounts. Amazon, Meta, all dumping tens of billions into GPUs, data centers, power infrastructure. Total AI infrastructure spending in 2025, estimated at over $200 billion globally. That's more than the entire GDP of many countries spent in 1 year on AI compute capacity. Nvidia can't make GPUs fast enough. Their H100 chips are selling for $30,000, $40,000 each. Lead times are 6 to 12 months. Companies are desperate for compute capacity. Energy consumption is exploding. A single large AI training run can use more electricity than a small city uses in a year. New data centers need their own power plants. Utilities are building capacity just for AI. And the promise underlying all of this spending? That AI will generate massive profits that justify these investments. Companies tell investors, we're spending $60 billion this year, but AI will generate hundreds of billions in revenue and profit in coming years. The market believes it, or at least the market believed it until now in 2026. So what exactly are companies selling? Let's look at the revenue streams in 2026. OpenAI. ChatGPT Plus at $20 a month. ChatGPT Enterprise at $25.60 per user per month depending on features. API access for developers. Estimated revenue, $3.4 billion annually. Microsoft, Copilot for Microsoft, $365 at $30 per user per month. GitHub Copilot at $10.20 per user per month. Azure AI services, estimated AI-related revenue, $10 billion annually. Google, Workspace AI features. Cloud AI services, estimated AI-specific revenue, $8 to $10 billion. Others, Anthropic, Claude, Midjourney, Character.ai, dozens of AI startups. Collectively, maybe another $5 to $8 billion. Add it all up, and the entire AI industry is generating maybe $30 to $40 billion in revenue in 2026, growing fast, maybe 80 to 100% year over year. Sounds impressive, except The industry is spending $200+ billion per year on infrastructure. Companies have invested $500+ billion total. Stock market valuations have increased by over $5 trillion based on AI expectations. The math doesn't work. To justify current spending and valuations, AI needs to generate not $30 to $40 billion in revenue, but $300, $400 billion. And not eventually, soon, within 2 to 3 years. Is that realistic? And that's the question investors are asking in 2026. Here's what's actually happening with enterprise AI adoption in 2026. Pilot purgatory. Thousands of companies ran AI pilots in 2024, 2025. Small projects, testing use cases, most showed promise, but transitioning from pilot to full production deployment, that's where things stall. Why? Because production deployment requires data integration, messy and expensive, change management, employees resist, accuracy requirements, AI errors in production are costly, regulatory compliance, especially in healthcare, finance, and ROI justification, hard to quantify benefits. The 80-20 problem. AI handles 80% of tasks easily. The last 20%, edge cases, exceptions, complex judgment calls, are incredibly hard. But you can't have a system that works 80% of the time in production. You need 99% plus. Getting from 80% to 99% is exponentially harder and more expensive. The human-in-the-loop reality. Most AI implementations still require human oversight. AI drafts the email, human reviews it. AI suggests the code, human checks it. AI analyzes the X-ray, radiologist confirms it. So you're not replacing humans, you're augmenting them. That means costs don't drop as much as promised. The ROI challenge. CFOs are asking, we're spending $5 million per year on AI tools and infrastructure. What's the return? And in many cases, the answer is vague. Improved productivity, better insights, competitive necessity. But hard dollar returns? Difficult to quantify. Subscription fatigue. ChatGPT Plus at $20 a month. Copilot at $30 user. Another AI tool at $15 user. Another at $25 user. Companies are accumulating dozens of AI subscriptions. Finance departments are pushing back. Do we really need all of these? This is the reality hitting in 2026. AI is useful. It's transformative in specific use cases, but it's not generating the revolutionary productivity gains and cost savings that would justify the spending. By 2026, warning signs are everywhere if you're paying attention. Enterprise churn is rising. Companies that signed annual contracts for AI tools in 2024 are not renewing at expected rates. Some are downgrading from enterprise plans to smaller deployments. Others are canceling entirely after ROI reviews. Usage metrics are plateauing. ChatGPT had explosive growth through 2023-2024. But by 2025, growth slowed significantly. Monthly active users are still growing, but nowhere near the exponential curve everyone expected. Similar patterns across other AI products. The promised use cases aren't materializing. Remember when everyone said AI would revolutionize customer service? Most companies still have human agents because AI can't handle complex issues. Legal document review? Still mostly humans. Medical diagnosis? Humans with AI assistance, not AI replacement. Price competition is intensifying. In 2023 to 2024, AI companies could charge premium prices because demand exceeded supply. Now, competition is fierce. OpenAI cut API prices. Google cut prices. Amazon cut prices. Margins are compressing before revenue even scales. The talent costs are insane. AI engineers command $300,000, $500,000 plus salaries. Top researchers get millions. Companies are burning cash on talent that in many cases isn't generating proportional returns. Energy costs are becoming prohibitive. Training large models costs tens of millions of dollars. Running inference at scale costs millions per month. As deployment scales, energy costs become a huge burden on margins. These cracks are showing up in earnings calls and corporate guidance and whispered conversations among CFOs. And then comes that Wednesday in 2026 when Nvidia mentions customer digestion, the trigger that makes everyone realize at once the emperor has no clothes. Let me walk you through what happens when the market realizes the AI returns aren't coming. Nvidia's earnings call happens. By the next morning, the sell-off is in full force. Nvidia down 18%, but it spreads immediately. Microsoft down 12%. Investors realize Copilot adoption is slower than expected. Google down 10%. Cloud AI growth is decelerating. Meta down 8%. Amazon down 7%. The Magnificent Seven tech stocks that drove market gains for 3 years, they lose $1.2 trillion in market value in 48 hours. Financial media is in full crisis mode. Is the AI boom over? Have investors overestimated AI returns? Analysts scrambling to downgrade price targets. But here's the key. This isn't just about Nvidia or tech stocks. This is about the realization that the entire AI investment thesis might be flawed. If customers are pausing deployments and evaluating ROI, that means they're not seeing the returns. If they're not seeing returns now, when will they? And if they never do, what happens to all that invested capital? Within weeks, the panic spreads beyond mega-cap tech. AI startups get hammered. Companies that raised at absurd valuations based on growth projections, now those projections look unrealistic. Private market valuations collapse. Late-stage startups that were unicorns at 1 billion plus valuations see down rounds. Some shut down entirely. Venture capital freezes. VCs who raised massive AI-focused funds suddenly can't deploy capital. Limited partners are demanding better returns. New fundraising becomes nearly impossible for AI companies unless they have clear paths to profitability, which most don't. IPO market slams shut. Companies that were planning IPOs in 2026 cancel or postpone. The market has no appetite for money-losing AI companies anymore. Enterprise software companies suffer. Any SaaS company that pivoted to AI, added AI-powered features, or positioned themselves as AI plays, their stocks get crushed. Investors realize the AI features didn't justify the valuation premiums. Cloud providers face pressure. Microsoft, Google, Amazon based huge CapEx plans on AI workload growth. If that growth slows, they're stuck with massive overcapacity. AWS revenue guidance disappoints. Azure growth decelerates. Cloud stocks suffer. Chip stocks beyond Nvidia, AMD, which was positioning as Nvidia alternative, drops 15%. TSMC, which makes chips for AI, drops 12%. Memory makers like Micron that benefit from AI demand drop 10-15%. The entire semiconductor sector is repricing. Over the following quarter, earnings season arrives, and it's brutal. OpenAI reports they're starting to disclose some metrics as they prepare for eventual IPO. Revenue growth is slowing from 100% plus year over year to maybe 60%. Customer churn is higher than expected. Enterprise deal sizes are smaller than hoped. The path to profitability looks longer. Microsoft reports that Copilot adoption is below targets. Many companies that trialed it didn't convert to full deployments. Usage among paying customers is lower than expected. They're revising AI revenue projections downward. Google admits that cloud AI is seeing pricing pressure and longer sales cycles. Translation: customers are price sensitive and taking longer to decide because ROI is unclear. Meta reveals that their massive AI infrastructure investments aren't translating to advertising revenue growth as expected. Advertisers aren't paying premium prices for AI-targeted ads. Across the board, the story's the same. AI is growing, but not fast enough to justify the spending and valuations. Analysts start doing the math. Nvidia spent $30 billion building capacity for $60 billion in AI chip revenue. Microsoft spent $65 billion on AI infrastructure for maybe $12 billion in AI revenue. Google spent $55 billion for maybe $10 billion in AI revenue. The entire industry spent $200+ billion for $30-40 billion in revenue. The return on invested capital is abysmal. At current growth rates, it will take 10-15 years just to recoup the infrastructure spending, never mind generate profits. That's not how tech investing works. Investors expected 3 to 5 year payback periods maximum. 10-15 years means the IRRs, internal rates of return, are terrible. Within months, companies start making painful decisions. AI teams get cut. Those $400,000 a year AI engineers, companies realize they're not generating $400,000 in value. Layoffs begin, not just at startups, at Google, Microsoft, Meta. Thousands of AI researchers and engineers let go. Projects get canceled. Internal AI initiatives that were funded generously in 2024-2025, CFOs are demanding ROI. Projects that can't demonstrate clear returns get shut down. Billions in sunk costs written off. Infrastructure spending slashed. Microsoft announces they're reducing CapEx by 20% for the following year. Google follows. Amazon follows. The $200 billion annual AI infrastructure spending is going to drop to maybe $120 billion. Nvidia's customer pipeline just evaporated. Startups implode. AI companies that raised money in 2024, 2025 are burning cash, assuming they could raise more. Now they can't. Mass layoffs, shutdowns, acqui-hires at fire sale prices. The startup graveyard fills up fast. Consolidation accelerates. Larger companies buy distressed AI startups for pennies on the dollar, not because they believe in AI, because they can acquire technology and talent cheaply. This isn't contained to tech. The AI boom created ripple effects throughout the economy. Real estate, data center reites were hot investments. Suddenly they face overcapacity as AI infrastructure spending cuts. Industrial real estate in areas with cheap power, built for data centers, now has uncertain demand. Energy sector. Utilities that built capacity for AI workloads face stranded assets. Natural gas plants built to power data centers aren't needed. Clean energy projects tied to AI demand get canceled. Employment. Beyond direct AI jobs, support industries suffer. Construction workers building data centers, equipment manufacturers, consulting firms selling AI implementation services, all face demand collapse. Stock market. The S&P 500 was driven heavily by tech. With tech down 20-30%, the broader market drops 12-15%. Trillions in retirement account value evaporates. Venture capital ecosystem. AI was 30-40% of VC investment in 2024-2025. That capital goes elsewhere or doesn't deploy at all. Startups across sectors face funding challenges. So why is 2026 the breaking point? Why not earlier or later? Companies started deploying AI seriously in 2023-2024. They told boards and investors, we'll see returns in 18-24 months. Well, 18-24 months from mid-2024 is 2026. The timeline has arrived, and the returns aren't there. CFOs who approved budgets in 2024 based on promises of AI productivity gains are now doing postmortems. We spent $10 million on AI initiatives. What did we get? In many cases, the answer is not much. Some productivity improvements, some interesting pilots, but nothing transformational, nothing that justifies continued massive investment. The grace period is over. Now AI investments have to show returns or get cut. Every technology goes through Gartner's hype cycle. Innovation trigger, peak of inflated expectations, trough of disillusionment, slope of enlightenment, plateau of productivity. AI hit peak of inflated expectations in 2023-2024. By 2026, we're entering the trough of disillusionment. The narrative shifts from AI will transform everything to AI is useful for specific tasks, but not a panacea. That's actually accurate, but it's not what investors priced in. Media coverage shifts from breathless enthusiasm to skeptical analysis. The AI boom that wasn't. Did we overestimate AI? The trillion-dollar bet that failed. Once the narrative flips, momentum reverses. Money that flooded in on hype floods out on disillusionment. In 2023, OpenAI had a massive lead. GPT-4 was clearly superior. They could charge premium prices. By 2026, Google's Gemini Ultra is comparable. Anthropic's Claude 3.5 is excellent. Meta's Llama models are open source and capable. Chinese models from Alibaba and others are competitive. Suddenly, OpenAI doesn't have a monopoly. Competition drives prices down. Differentiation becomes harder. The AI industry looks less like winner-take-all and more like commoditized utility. Lower prices mean lower margins. Lower margins mean harder path to profitability. Harder path to profitability means lower valuations. Training GPT-4 reportedly cost over $100 million in compute. GPT-5, or equivalent, could cost $500 million to $1 billion. Running these models at scale for millions of users, the inference costs are staggering. OpenAI is reportedly losing money on every ChatGPT Plus subscriber at $20 a month because inference costs exceed revenue. Companies are realizing to make AI profitable, they either need to raise prices, kills demand, or massively reduce costs, requires breakthrough improvements in efficiency. Breakthrough improvements aren't materializing fast enough. Incremental improvements are happening, but not at the pace needed to make economics work. Governments are regulating AI. EU AI Act, US state-level regulations, China's tight controls. Compliance costs money. Some use cases become legally prohibited or restricted. The regulatory burden slows deployment and increases costs. Additionally, copyright lawsuits against AI companies are proceeding. If AI companies have to pay licensing fees for training data, that fundamentally changes economics. ChatGPT in late 2022 was magical. It was new. It was amazing. Everyone wanted to try it. But subsequent releases, GPT-4 was better than GPT 3.5, but not transformationally so. Claude 3 is great, but not dramatically different from Claude 2. Gemini Ultra is impressive, but not revolutionary. The pace of improvement is slowing. We're hitting diminishing returns. Each new model is incrementally better, but not game-changing. Without regular wow moments that drive new adoption waves, growth slows. And if growth slows below expectations, valuations collapse. By 2026, the economic environment is challenging. Interest rates are still elevated. Fed funds around 4 or 5%. Growth is slowing. Corporate profits are under pressure. Investors are risk-averse. In this environment, speculative growth investments get hammered. Money flows to safety, value, cash flow. AI companies burning billions with unclear paths to profitability. That's exactly what investors don't want in this environment. The macro backdrop amplifies the AI-specific concerns. So here we are in 2026. The AI boom that started with ChatGPT in late 2022 has driven 3 years of market gains, created multiple trillion-dollar companies, and consumed $500 billion in investment. And now investors are asking, where are the profits? Revenue is growing, but not fast enough. Costs are massive and not declining fast enough. Adoption is slower than expected. ROI is unclear. Competition is intensifying. Margins are compressing. The math doesn't work. To justify current valuations and spending levels, AI would need to generate hundreds of billions in profits within a few years. But the path to those profits is murky at best. Companies spent $200 billion on AI infrastructure in 2025. They generated maybe $35 billion in AI revenue. That's a 17% return on capital in year one. You need much better than that to justify the investment. When Nvidia says customers are pausing deployments to evaluate ROI, they're admitting that customers aren't seeing returns. And if customers aren't seeing returns, they'll stop buying. And if they stop buying, the entire AI infrastructure investment becomes stranded capital. This doesn't mean AI is useless. AI is genuinely useful and will remain part of the technology landscape. It will improve productivity in specific domains. It will enable new applications. But useful technology and profitable investment are different things. The internet was transformative, and most .com companies still went bust. Cloud computing is essential, but the migration took 15 years, not 3. AI will follow a similar path. It's real, it's useful, it's not going away. But the timeline and profit expectations were wildly unrealistic. The bubble isn't that AI doesn't work. The bubble is that investors expected too much, too fast, and paid prices that assumed perfection. When reality falls short of perfection, even if reality is still pretty good, valuations collapse. That's what's happening in 2026, not the death of AI, just the recognition that the AI boom was overhyped, overfunded, and overvalued. The correction won't be quick or painless. Trillions in market value will evaporate. Thousands of jobs will be lost. Hundreds of companies will fail. But when the dust settles, AI will still be here, just smaller, more focused, more realistic. The question is, how much pain comes before we get there? And in 2026, we're about to find out.